Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm here once again with my good friend, Morgan Paxhia. He is the co-founder of Poseidon. Morgan, long time, man. How have you been?
I know. We're back in the saddle. Good to see you again. And here we go, 2026.
Here we go. Making sure I know how to turn this music off once I got it started. There we go. I turned the music off now. Yeah, man. A big year. You know, you and I have been talking a lot, Morgan. We've got some good goals for the podcast. So yeah, I'm fired up, man. I think we've got a good opportunity in cannabis this year, and I'm excited to see how we can evolve the show and make the most of it.
Yeah. Oh, yeah. It's up and to the right for Higher Exchanges.
And we're starting off the year with the perfect guest. He's been an investment banking analyst. He's done M&A for Anheuser-Busch. He's worked as a cannabis operator and now is managing director at Arlington Capital Advisors. He's Dai Trong. Dai, welcome back to the show.
Hey guys, thanks for having me back, and excited this lined up so well with all these announcements we have on M&A.
Yeah, I'm excited to chat. When you were on Dai last time, were we doing it via Spaces back then? I know you were on once before. Is that right?
We were on the Spaces, so this is also my first time on this new setup.
Cool. Yeah, man. It seems like Spaces in general have really died down. I don't see them as much in cannabis. I see them a little bit in crypto, but it seems like that platform, at least in our world, feels like it's lost momentum. Yeah. Well, on the other good news today, guys, we are excited to share that Higher Exchanges is presented by Flowhub, the retail platform behind the best dispensaries in America. Flowhub powers some of the largest and most sophisticated operators in cannabis. If you're serious about scaling retail the right way, visit flowhub.com and request a demo today. So Morgan, really excited to have Flowhub on board. I know it's a company that you know well. Kyle's been on the show. I think he's a great voice in this space. So excited to have a sponsor, but especially excited to be starting out so much on the right foot with a team like Flowhub.
Oh, absolutely. Yeah. When Kyle brought this up a couple of weeks ago, I was like, this is a great time to be talking about it because, we've been seeing a lot of growth and across our platforms. And so, we're ready for it and let's go. And so yeah. Love that mentality from Kyle because he's all about action. He's about progress and making stuff happen.
Every time I see the guy, I think I didn't see him. I saw him. I didn't have a chance to talk to him when I was in Vegas, but he's always charging around and getting stuff done. There's a lot of energy to him. So he talks and he has a good voice, but he also, it seems like he's big on the action side as well.
Absolutely. Yeah. He's, whenever you're feeling low energy, you just call Kyle and he'll top you up.
He is the sativa of the cannabis industry, you might say.
Yeah, that's right.
So Dai, welcome back, man. It's good to chat with you. We wanted to have you back on. We thought you had a really great first appearance, and I think you're one of those voices. You do a lot of writing, you do a little talking, and I feel like the operators in the industry know you, and some of the more sophisticated investors do. But I feel like on the retail side, maybe some of these folks aren't as familiar with you. So I was excited to have you back on. And for folks that maybe didn't hear the first episode or need a refresh, can you just give us a quick overview of who you are and what you're up to these days?
Yeah, definitely. So I've been at Arlington now for about 5 years. We started about 20 years ago, very organically, first in restaurants, which then sold a lot of beers on tap, which then meant, some of these beer wholesalers, distributors started looking to cannabis about 7 years ago. So I actually reconnected with my colleagues when I was at MedMen 7 years ago when they were working on behalf of a couple of beer wholesalers looking to invest in cannabis companies. And that connection between beer and cannabis for us started with Sweetwater when we sold that to Afria, which is now Tilray, which I think is actually reporting earnings today. But that deal was about 5 years ago, which just goes to show how long it takes a strategy to play out. And it's still playing out in still very early days of this brand strategy that Tilray has enacted.
That's great. And what kind of deals are you mainly focusing on in the cannabis industry these days? I know we're going to get into some of the recent ones, but is there a particular angle to your business or type of company you guys specialize in helping?
Yeah, we're very brand focused. So going back to that Sweetwater acquisition, we've sold a couple of other companies to Tilray since. We're in a process right now with another craft beer company that they've looked at. We probably show them 4 or 5 craft beer companies a year. So I'm excited to talk about one of the transaction because I've been very brand focused for so long. And I think this is kind of the catalyst to get more of these brand deals done. And I'm sure you guys had similar conversations at MJ Biz, but that was for the first time in a few years at MJ Biz where we actually talked about brand acquisitions and not just MSO or single state opportunities for some of these larger players.
Yeah, and maybe so we can get into it. I don't want to spoil the agenda, but one thing to bookmark for later is maybe some of the distressed stuff is starting to move too. Like I think the deal you're talking about was, two companies that were doing well, but I feel like in the industry too, people are starting to sort through the rubble a little bit. We might see some more activity in some of the I would call distress is a weird term, right? But maybe some of the companies that are struggling that people don't quite know publicly yet that they're struggling so much.
Yeah, I think that's the right term for it, or just very opportunistic, very value-based plays, right? Where I'd say the distinction between where we're at now in M&A and say 2018 is that valuations are, very attractive, right? Back then, let's say for a dispensary or a single state operator, you might be talking about multiples of revenue. Now you're talking about like 6 times EBITDA, which in any other business for CPG, for retail, 6 times EBITDA is very, very attractive. And we've kind of seen it, not to, again, spoil the agenda, but where some of these MSOs have walked away from transactions that may not make sense, right? We saw that with Curaleaf acquiring the cannabis company's assets in Virginia. They had a go shop provision. It was too expensive, and they just walked away. Someone else that may have not been as disciplined bought that asset instead.
Mm-hmm. The last time we did a higher exchanges, it was with Hirsch Jane and Scott Grossman. It was coming fresh off that rescheduling announcement day. It was a really exciting show. And during that show, we talked a lot about what our expectations are in terms of how things change with Schedule 3. Like we know kind of the big headline things about 280E and medical research. I think we understand those pretty well, but I'm interested in kind of what you think some of the second order effects are. Like, what are you most excited about with Schedule 3? And is there anything people might not be thinking about as something that's going to change that you see could improve as a result of getting a final rule?
Yeah, I think what I like to point to is timing. Everyone seems to think valuation has kind of flipped the switch overnight. That's not happening overnight, not very near term, right? Most of the work I've done and the work I've seen other people do seem to think this is 18-ish months, right? Whether it's 15 to 24 months, somewhere in that time frame. So these valuations aren't changing overnight because these balance sheets and these P&Ls aren't changing overnight. So I think when, for M&A purposes, you're going through the process, you're having these discussions, you can't just say, okay, well, now my valuation has doubled. That's not necessarily true. It will improve as things progress the next 18 months or thereabouts. But I think the perception of things changing because of this announcement for Trump to push rescheduling, that does not change your valuation right off the bat.
Yeah, I agree. And I think what changes valuation, well, it's always a supply and demand equation. But here I'm thinking more towards the demand side of things, Day. And I think one thing we're going to feel the consequences of is how long this bear market has gone on and how much it's tortured investors. And I feel like each time that MSOS, sells off and people are losing money, that's one more time people are thinking, I don't want to do this again. I don't want to do this again. And it feels like there's not really the momentum or the buying group to be putting money in until they feel really confident about that. And what I mean is you have the retail investors where you double down once, double down twice, you double down 5 times, and either you're out of money or you're pulling it from other investments that might have been doing better. So that basket is worn out. And then the one we're all excited about over here, which is the institutional, or at least the larger basket. Institutional is a weird term too. Like I don't expect, CalPERS and big pensions to start dumping money into cannabis, but I think we can work our way up that food chain. But the problem is that it's going to take a little bit of time for that work to be done. And each head fake cost us a bit. Each time it didn't happen cost us a bit because people won't do the work now until they're like, tell me this is 100%, and maybe even tell me the final rule is done, and tell me there's going to be a little bit more to this. But at least it feels like to me, Dave, from the conversations I was just talking to one of the biggest investment banks in the space yesterday, and they were kind of sharing the same view that there is money out there, but it's going to be a bit slower moving. And maybe upon the final rule, we get a pop, but to actually bring in the real dollars for the lasting move could take a little bit of time.
Yeah, that's exactly it. I think people have been burned one too many times. Like I'm more than happy to be wrong about timing, right? That 18 months I threw out, if it happens next month, 3 months from now, I'm very happy to be wrong about that. But I think with retail, with institutional investors, you've just been burned one too many times the last 5 or so years that you can wait to do the work. And, similar to that conversation, I was talking to Elliot from Ignited, formerly Benzinga, about next month. They're doing something in Jersey City. And his question was, do you think more investors will come to that event or come back to the table? And I think they're starting to think about it. right? They're coming back now to do the work again. Pencils were down for, a year and a half, 2 years or so, but now at least this headline news, this somewhat positive momentum will get them to come back to just doing the work. So they might not write a check just yet, but they're coming back to do the work. And hopefully that means in 6, 9, 12 months time, when balance sheets get better, consolidation happens, investors will actually deploy checks then.
Mm-hmm. Yeah, and I know, Morgan, you and I offline have been talking about a bunch of different M&A deals going on. There's a lot of activity in the space. Why don't I pass the mic over to you for a little bit to talk about where we are in the cycle?
Yeah, well, I mean, Dai, you nailed it from the perspective of, a lot of capital sources just put pencils down. And that was a very long, painful period, understandably, because they were just waiting to see how these companies would shake out. We had a lot of price compression issues. We had limited new states turning on. You had a concern around when we would ever see any federal progress. And so they were just like, from a time allocation, just kind of seemed like they were happy to wait and see how things would shake out. And boy, has it been a shakeout, because it's definitely put a lot of pressure on the system, and just a tightening of liquidity when you don't even have M&A through a lot of, I would say most of last year, it was very quiet. But then all of a sudden it seemed to start ticking up. And without, this was before rescheduling executive order. Obviously that was very late last year. But action just started to happen. And it seemed like, to your point, it was this opportunistic, there were some deals where it was just like small kind of tuck-in deals with the larger operators, and understandably where they were trying to reach certain caps in states, and, just being very thoughtful. They weren't going to do anything large because they didn't know where they were going to be. And, to your point before about, valuation, the challenge is for a public company, if they're already trading single digit EBITDA, how can they transact without it being dilutive over accretive? So they naturally push them down into an area where they can transact, and which does point to these like, kind of like liquidation like scenarios of these companies that just, it's either the choice of shutting down or selling and taking a low price, or whether it's forced by the courts, because of whether it's a state level kind of bankruptcy process or what have you. But it is picking up, and we've seen quite a few deals announced as we wrapped up fourth quarter, and we're already seeing deals being announced in the very short part of 2025. There has been a lot of these kind of cleanup situations, but it does seem like the cycle is picking up some steam. But just given how long of a drought we had, how long do you think we're going to be? Like, where would you say we are in this M&A cycle? Is this just like the first at bat of the first inning, or like kind of how do you think about where we are as this is as more transactions are picking up?
Yeah, I like to use a dating analogy here. I think, probably the last few years, so exclude the last 6 to 9 months, people were kind of dating around, going as many dates as possible. I think now conversations have gotten more serious. People are ready to, talk about engagement. People are, in that example with Wild and Groom getting ready to get married. We had a lot of these conversations that have been ongoing now for years and years, and I'm sure you experienced that with your portfolio companies as well, where you couldn't find a workable deal, whether it was liquidation preference, whether it was two things merging and the ownership structure not working out, or percentages not working out. A lot of conversations, but now I think 2-3 years after those conversations first started, you have real companies that now are more serious about actually transacting. And so I think where we are is, I would say we're in kind of the 9 to 12 month phase of conversations that have started being serious, right? So going back, some of these things that are announced, they've been in the works. They were in the works since last summer. It just made sense in December with some positive news, and maybe different situations and all these deals we'll talk about, but it made sense for some of these things to happen. So I think that's where we're at in M&A today, which is exciting because for so long we've been making the introductions, being a part of these conversations, knowing things that could have happened, and sometimes for better, right? Some of these SPAC transactions, like I talked to some of these same companies, they were very happy not to have gone into some of these SPACs. So yeah, I think that's kind of where we're at in the cycle today.
Yeah, and I certainly agree. Like, trying to get deals actually to the finish line over the last couple of years has been maddening to say the least. We have certainly several companies across the firm, and deals that have dragged out 18 plus months. It's just absolutely absurd. But just of that, and I can't point to any one reason. I think it's various reasons of these delays, but now it feels like the energy is finally changing, where it's not so much of we need to go on 50 different dates and see how it's going to go, like if this is going to happen. And I do wonder, does the S3 executive order, does this accelerate things, or as you were saying earlier, is it's going to still be a slow building kind of traditional cycle? This just might bring more capital to the table. Like, how does rescheduling factor into, regardless of valuation, put that aside, just how does that impact the cycle?
Yeah, it certainly moves the needle on both sides, right? You have buyers thinking, if not to talk about valuation, but if I move sooner before things actually change, I can get a better price. Whereas some of the sellers may want to hold off now because they think they'll get a better price, right? So it's doing that dance once again the next year and a half or two, and figuring out when's the optimal time to sell, when am I going to get the best pricing? And if I don't do that, will a transaction then walk away and I'm the last one at the dance? So I think it does accelerate these conversations. I've seen since those announcements a lot more email traffic and text and phone calls around M&A in the space.
Yeah, I share that. I mean, it's every single day now is, these conversations. It's like before, I think there was so much hesitation that people were willing to kind of fight that bid ask, right? Where they were trying to hold out or see what else was coming or what. But now I think there's just been a mental shift of like, let's focus on, let's get things done. And I don't know if that's a part of a hangover from just how long the window was closed. So people feel like there's some urgency to act in fear of like, how long is this going to be open? We'll have to see in time, but there certainly is like a lot of energy around, let's move and not wait. And I appreciate that, because I think you want to make sure you're doing right by your investors and following things through and getting the best you can. But timing is, no one knows how, something could change, and the window could close. So, if you think this is the optimal outcome, regardless of if it's max value, it makes sense to move forward. But like, as I think about, Vireo has been just an animal in rolling up things, right? I mean, they kind of came out of the blue almost, it felt like, where, it was just almost feels like one deal after another, and they're just moving and moving. They did the, like Schwaz, that one, I know people in the know were aware of it, obviously, but, for a lot of folks, that was a big move. And then shortly thereafter, it was, they got the PharmaCann Colorado transaction. And then, what was it, a week later, then they announced Ease. I mean, it was just like, boom, boom, boom. It was, and, from what we hear in the rumor mills of the marketplace, I'm not saying anything I don't know for sure, but it seems like they are, hunting for more. Like they are just moving, while most of the other MSOs are, maybe still in this kind of like tuck-in mode, or, still dancing. But I guess what I'm wondering is, obviously they're moving fast. And at what point does that start to pressure some of these others that they got to start acting, or else, before long, they're going to turn around and Vireo is going to be this very significant player in the market? I mean, they already are becoming very significant, but I mean, how many more of these deals is it going to be before it's going to, just bring more into the, into that kind of orbit of activity?
Yeah, so the one transaction that started all that you didn't mention was the 4 SSO acquisitions, right? That was Proper Brands, Deep Roots, Harvest Wholesome, and the Flowery. So that was December 18th, 2024, and the Ease of last year, or I guess 2 years now. And then Ease was December 23rd, 2025. So over a 370-day stretch, they did all these acquisitions. And the Schwaz one was, I think, October. So if you think about it, these 4 SSOs took about 9, let's say 10 months to integrate. And then they were ready to go out and figure out, okay, how do we add on to this platform that we're building? So Schwazze, PharmaCann, Ease, right? That's all Colorado. That's how they're now at 55 stores in Colorado. Ease, that's how they've strengthened Florida as well. That's also why now they have a delivery tech capability across all the states that make sense to have delivery. And so I think, they'll probably take a few quarters to integrate some of that, especially in Florida with implementing Ease and kind of blowing that up a bit further and integrating that with the Flowery. So I think, the other thing I know also is people are coming to them now, right? When you think about exit opportunities, they're on a short list of MSOs that you would exchange your equity into. If you want to go further into it, I mean, Jim Clark, essentially, who was the owner and funded with cash most of Ease, said, I'd rather trade the cash I've invested in Ease into Verio, and I trust what that team is doing, that platform that they're building. And to answer your second part of that question, they have more of a clean slate, right? They're not in 10 states, 20 states already, like some of these other MSOs that have had to look at going deeper in a few states, going into new growth states, or even international in Curaleaf and a few of the other larger MSOs. They have a clean slate to kind of figure out what markets can we go into and build a vertical operations that actually makes money. And that discipline, right, the connection between Verio and some of the credit plays in this industry is that they have that history with Chicago Atlantic. So they actually know how to build a company that's going to be cash flowing, that's going to be great to creditors, that will likely be great if the public markets open up again.
Right. And interestingly of that, and I'll pass to Jesse, but as how they've gone about these deals is, it's not like it's been the same approach. They've used multiple levers of affecting these transactions, right? One was, like you said, was stock, some was asset purchase, some was assumption of debt. It's been of various forms to affect these transactions. So, showing that they do have a depth of understanding on how to do M&A and to do it very quickly.
And why do you think, Dai, that Verio is closing these deals or biting on these deals that I assume get shown to the other, top 5, top 10 MSOs about there? What do you think Verio is seeing here that others are passing on?
Yeah, I think the need also, right? They need some of these assets more than, let's just talk about the top 4 MSOs. They need some of these assets more than others, right? They didn't have as deep of a play in Florida. Colorado, that was probably very opportunistic, where they could have picked up Schwazze, some of that talent, some of that market share very early, and then maybe they liked what they saw over the course of 6 to 9 months and wanted to go deeper. So when PharmaCann's Colorado assets came up, when Ease came up, it made sense to go deeper and really just dominate that entire market. So I think they've been very strategic because they've had that kind of cleaner slate and haven't gone as deep into some of these markets. And as you know, there are limit caps in some of these markets. So there are certain states where an MSO is not going to look at an acquisition because they're already capped out.
Yeah. Well, let's transition and talk about something that's more local for us here in California, and that's the Gold Flora and Steezy deal. And that's local to me in a couple of ways. We have a Gold Flora door called Coastal in Santa Barbara, so I drive by the store all the time and have been there several times. And I also, as an analyst, used to cover Gold Flora for a while back in the day, so I got to know Lori and the whole team pretty well. And along with that day, did a bunch of site visits, went out and saw the campus in Palm Deserts, one of those cities in the Palm Springs area where they have that huge indoor facility at the extraction lab and the distribution. And then on the other side, we had the retail footprint, which has some really great doors in it. The Santa Barbara store is a pretty store and I think does decent numbers, but especially up in the Bay Area, Dai, are they aviation branded? The 2 in San Jose, the one by the airport.
That's exactly it. And those crush it, given the proximity to the airport. And then I think Long Beach is the other stellar retail location.
Yeah, have you been to the one in San Jose that used to be a bakery?
I have been to a lot of these locations as a reminder of these SPACs and some of these transactions, right? Left Coast Ventures and Kaliva formed the parent company, which then was acquired by Gold Flora, which then, these assets have been acquired by Steezy. And I did M&A for MedMen. So I visited a lot of these locations and have been to a lot of them. Yeah.
Yeah. For people that don't know, they have one in San Jose that used to be I think it was an Entenmann's Bakery or something like that. And it has the grow co-located there. So there's a bunch of small grow rooms, and then there's a dispensary on site as well. A really cool store. But I say that all day because it was a business that really struggled and eventually went into receivership. But at the same time, it was a business that had some great assets. And so when they were looking to dispose of the assets, I was curious who was going to pick those up. And they had, what was it, a dozen doors Steezy ended up buying for 25
or 25. Yep.
Yeah, 12 for a dozen doors for 25 million. So a little over 2 million per door. Probably not right to say 2 million per door because it's not, some of those doors are probably a multiple of that, and some are probably worth quite a bit less than that. But just curious, your overall thoughts. Dai, I think with Steezy, that now takes them to 58 stores in California is what I have in my notes, 61 stores total, counting Michigan. And for people that don't see the play here, I'm guessing, and I'm curious to get your take, Dai, because you're a lot more versed in this stuff than me, but I imagine the verticality is a huge thing here. Gold Flora was getting pretty vertical, especially with the push of the Grambling brand. But sometimes with these doors and businesses, one thing that doesn't work for somebody can work pretty well for somebody else with a different product mix that could really push the margins by being vertical. So curious to get your take on what makes it work for them and your overall thought on the transaction.
Yeah, I mean, that's exactly it. I mean, at its peak, Gold Flora was doing 100 million in revenue, and we know obviously the market's come down a little bit, but to be able to scoop up 12 of these stores, and the one you mentioned, the flagship store that actually Gold Flora acquired, Airfield Supply Company in San Jose. I mean, that location at its peak, I remember, it's like 22 million in revenue, right? Obviously, we can't count on that anymore, but you have a roadmap to get back, most of that revenue. I think it's a great purchase price. You're talking about buying it, Jesse, like you said, a little under 2 million a store, at one, and assume any of those stores, let's say, even if we say $5 million, right? So 60 million potential between the 12 stores, and that's being quite conservative. You're paying, 0.3 times revenue, which is really attractive here. And I know more lately on California retail, things have been happening on EBITDA. So 4 to 5 times EBITDA. Don't know what those EBITDA numbers are, but if Steezy believes in that vertical integration, further profitability, that math will just make a lot of sense for the 25 million that they spent.
Yeah, and Steezy, we think about them with the vape carts, but they've done a nice job expanding into a bunch of other form factors as well. I know I think they're still doing some of their own extraction, but they put out jars of dabs and things like that. Last time was at the dispensary.
Flour, edible,
flour,
even.
Yeah. And I think we know them for we think of them, at least I do, and I think most people do, with the vape cart, with the hardware, and the vapes are always some of the top SKUs in California, but they've done a nice job building out a portfolio to put in those stores as well.
Yeah, and they're very smart about branding retail, right? Usually it's something plus area code. It's like authentic 509 or whatever it might be. So it doesn't feel like as a consumer, you're coming into a store and it's the Steezy store and you're buying Steezy products. So they've been very smart going vertical, and they're by far the largest company in California with that vertical operation today.
Was there another operator you were surprised didn't end up getting those stores?
Not necessarily. I mean, if you think about it, right? Most of the MSOs have exited California, have said they're not interested, won't get investors excited. I mean, don't know what the balance sheet looks like for Catalyst, but they've been picking up a lot of stuff as well. So they probably threw in a bid. I don't think Embark has been super acquisitive. So when you go down the list of who is the other dominant retailer in California, others may have thrown in a bid. Like I've talked to a few that threw in a bid, but maybe didn't have as much cash, or maybe couldn't find the cash, didn't have the credit quality to go raise the cash. So it came down to Steezy probably making the best offer, and from talking to their corp dev head, they got the best deal.
Hey, Steve, how are you? I know Steve listens sometime. I assume you're talking about Steve.
Yeah, is he on? I can't see who's on the live, but yeah, I'm talking about Steve.
Yeah, I can't see him either. I just know that Steve does listen from time to time. And with the rest, what's going on with the rest of that Gold Flora piece, Dai, with that cultivation, extraction, and everything that they have going on out in the desert there?
Yeah, since they're in receivership, I assume that's still kind of in an auction process. Honestly, I haven't kept much in front of that. Just that's not an area of focus for us. But I assume there's still some value there that someone might want to pick up. Funny enough, I think I saw something on LinkedIn from you about Leaf, and Glasshouse, right? Sort of
Mhm.
being the two dominant players in California as it relates to kind of flower, and then also potentially pieces for distillate. So I mean, kind of makes sense for you guys to have looked at it if you haven't. I assume you have, and probably Glasshouse and others who care about those assets and not the retail portion.
Yeah, for us, it's situations like that don't make a ton of sense. We're on the extracts only side, day, so we're growing specifically for extraction, and so we're doing lower cost sun grown. Our cost of cultivation out at our farm called Salisbury
Right.
Canyon Ranch is
Yeah.
about $8 a pound, and so it's pretty hard to make extracts, pencil from indoor material. But yeah, I think it does beg the question, right? Like, who's looking for 100,000 square foot of indoor in California right now?
Yeah. Yeah. That's going to be a large one to take down and doesn't make a ton of sense. That's obvious for anyone. And I know other have tried to build that out and others still have pursued it recently, but not in any conversations I've had that anyone's interested in even asking about that. Whereas at least for the dispensary assets, people were asking questions.
Yeah. And the next deal we wanted to talk about is one that I've done some Googling on to learn about, but was not one I followed closely. And that's Navis. Navis has acquired select assets of Humble Cannabis Solutions, expanding its wholesale and distribution infrastructure in California. My notes here, Dave, says the transaction adds $13 million in assets and about $20 million in gross sales, strengthening Navis's scale and operational footprint. And Navis plans to integrate Humble Partners into its platform, enhancing inventory, visibility, payments, fulfillment, and data tools for brands and retailers. So not a huge deal here, but kind of interesting. What were your thoughts on that transaction?
Yeah, so as a reminder, if you didn't know and didn't dig into Humble and Fume, that was basically backed by Johnson Brothers, right? That's when they're talking about Humble Cannabis Solutions, HCS, that's Johnson Brothers, a large alc bev distributor. So I kind of look at this as, that didn't work out from an investment. I think it was a joint venture they did with a venture fund, Green Acre. I think Cookies was on the platform as one of the brands they distributed in California. It didn't work out for Johnson Brothers, but this obviously signals that they're still very interested in cannabis distribution. And it was a way to kind of exchange their problem into something that's a platform, right? And I'll probably say that word over and over again with a lot of these M&A. That platform was something that they're excited about. So happy to give away the assets, the 4 million we talked about, happy to put another 4 million of equity into the combined company, and then to kind of support some of the growth initiative, another 5 million in debt. I was actually surprised that that 5 million wasn't maybe a smaller number and maybe that equity check wasn't a bigger number. But I think the thing I look at here is this is kind of like a sampling, early days. So let's work with Navis if I'm Johnson Brothers. And over time, as it continues to scale, they continue to execute, show best-in-class capabilities, we can invest more into this vehicle. So it starts the relationship officially.
Interesting. Well, why don't I pass it back to you, Morgan? I'm super excited for this next one, talking about Wild and Gruen a little bit. It's a big deal.
Yeah, well, interesting for, what we were just talking about, these previous deals, were, this opportunistic, low kind of transaction, getting deals done. What we think we would see pretty typical in this part of the early start of the restarting of the cycle. And I know we'll still see plenty of that. There's still plenty of cleanup to do, but this one I thought was really interesting because this doesn't seem like two distressed companies. This seems like two very healthy companies that are doing, very well and coming together. I mean, Wild has been just a wild ride to watch. I mean, they seem like they've shot out a cannon and built a great business. It seemed from everything we heard was, basically self-funded and just grew on cash flows and expanded like crazy. And so, and just dominant positions in so many markets, number one in their category in gummies, and just going state to state to state and just rolling out and going. And Gruen, was another one that came after them, I think, and faster growing and, doing great in their category. And I know you did a whole nice write-up on this, so I don't want to steal your thunder on it, but I mean, this seemed more like a truly strength begets strength kind of situation of two very strong companies coming together and just dominating a category. But what's kind of your take on this combination?
Yeah, it definitely was from a position of strength. They certainly didn't take a deal that had it be heavy loaded with equity, like we often see in some of the other deals that we've discussed. This one was pretty much majority or almost all cash. And if you think about this, going back to what I said about platform, this creates a platform. So there were about, I think, 8 states that Gruen is not in, that Wow is in. So very quickly, you can see they're going to take to these 8 states. I'm guessing California is probably the one that they're going to go with almost immediately, going back to that point. Wow is in California, Gruen's not. And this combination kind of bumps them in some states, key states like New York, where maybe their positioning was 3rd and 4th individually, to being 1st as a combined, edibles or brand house. And if you go back to kind of, I've known Aaron Morris, the CEO of Wow, for a while now. When the Wana acquisition happened, I kind of asked him, hey, did you get something from Canopy? And he said, well, it's $1 billion, so I don't think they would have paid me $1 billion then. But that's his ambition, right? So took a while, but now they're building this platform to truly, at some point, if not today already, become $1 billion valuation. And I'm pretty sure he's making $1 billion in revenue as well. Because now, similar to what we're talking about in Vireo, you're probably having brands that are of scale, that have cash flow, that if they didn't talk to Wow before, they're definitely hitting up Wow now to say, hey, we'd like to be a part of this platform. Like, we actually trust, this was a cash transaction, but if need be, we would take your equity for our equity in our company. So again, I'm very excited about this, very excited that this will kick a lot of similar conversations off, and hopefully we see more of these where you have brands that just make sense to combine, given the footprint, given the infrastructure, some of the growth opportunities, some of the strengths that each company have that others may not.
What's interesting is, Oregon is not a state that's talked about very much because it's been a very challenged state as a legal cannabis market. But if you think back over the history of cannabis, some of the largest exits are born out of Oregon, actually. Like, Curaleaf buying Select, that was a huge deal. These 2 companies are from Oregon originally, right? And
Smokies is also very large in Oregon as well.
Yeah. So just interesting that, the state does seem to have a little secret sauce in doing something that is gaining national attention. But what's also interesting to me, since you do a lot of work on the brand side, given how hard it was in this industry, most companies were just focused on verticality, and trying to be, these standalone brands was really tough to find a way to profitability, to generating cash, to doing things that could make viable businesses without needing to constantly be sourcing capital, and to have staying power with the consumer across a lot of different markets. It just seems like that's been a tricky thing in general. I know there's one-off cases, but I just thought this was really interesting. To your point, is this like potentially a new aspect of cannabis where you can have a platform of brands on a national scale that doesn't have to be a fully vertically integrated business and still be a very attractive from a growth and profitability perspective?
Yeah, because if you think about it, both Wild and Gruen took this reverse licensing approach to market expansion. So they're not beholden to an MSO where, hey, I'll bring my brand into your state, give me 15% of the economics. They're renting these licenses or setting up their own infrastructure or sub-licensing licenses, and they're capturing 85% of the economics. So they've grown very smartly from making that decision and kind of choosing their own destiny and not having to partner up with an MSO to take them somewhere. Because we've seen how that's worked out, right? If you go back and map out some of the brands I've signed up with, Air Wellness, with the Cannabis Company, you name it, right? You kind of tie your wagon to some of these MSOs that then go away or lose their dominant position in a state, and your business somewhat goes away. So it makes a lot of sense as a brand to be very asset light and try to control your own destiny by owning the economics in these states, owning those relationships, whether that's distribution, which Wild also has in all of their markets, or also owning sales and marketing and not just letting a third party do that.
Right. But it's interesting is like, how did they establish that, that consumer mind share to have them continue to come in and repeatedly be like, these are the products I need to have? Like, because, for all intents and purposes, I mean, a gummy is how do they differentiate to become, as they are today, with the consumer? Because I mean, it's also like this idea of like how brands have tried to reach in other states, and there's been various forms of success, but they've seemed to do it very successfully because of the consumer's adoption of their products.
Yeah, I mean, from my observation, it's just been every state they've gone in aggressively to land and expand. And that means, early days when they went to Colorado, right? Juana's backyard, went in, heavy discounting, BOGOs, you name it, just to make sure that consumers had a chance to recognize the brand, try the brand, and then you're competing on quality. And if the quality's there, the value's there, meaning that, for what you're paying, you feel like you're getting a better deal than a comparable edibles. That's how you get loyalty from a consumer. And then time and time again, as we have some of these new markets open up, and let's say, New York is somewhat of a newer market for them. If you move from some of these older, mature markets into New York, that brand's already recognizable. It's very easy for them to win consumers and keep them coming back. So I think, from my observation, since I've known them since 2018, they've just been very aggressive coming into states and trying to own that market share. And that's what I look at in this deal. It's just about winning market share. And, here's the other compelling thing to talk about going to investors, whether that's private or in the future public market investors. You can say you're the number one market share edibles brand in X amount of states, right? And you can now say that in more and more states with this combination. Whereas before, maybe in some states there were 2 or 3. Now you can say confidently we're number 1, and maybe by a 2x margin or whatever it might be over the new number 2.
So one last question, I'll pass it to Jesse. Is so now that they have this pretty solid position in this edible, aside from headsets, referred to them as they have dominating the shelf from premium chocolates to high velocity gummies. So if this is the emergence of this platform, how would you think? I know this is just for fun, speculative podcast fodder, but where do you think they would potentially look next to continue that trajectory?
Yeah, I think it has to be, again, going back to my history and kind of knowing the founders, it has to have cultural alignment first and foremost, right? They really care about that. And then, at the end of the day, it's bottom line. Is this going to make us money? Is this a good category for us to enter? Do we want to enter flower and, be out of our depth and be very competitive with a large amount of competitors? Or maybe do we go into pre-rolls? And again, speculating, but like I do know they're very close with like a Jeter. So do you go and acquire someone that's very, again, dominant and has a lot of market share in a category where there's less competition, there's a lot of profitability to go and attack? And then Jeter, if you think about it, for as big of a brand as we know they are, they're not in that many states. So again, that same playbook applies where you have this platform, you have all the states that's Wild is in. So wherever you end up paying for it, you can now bring them into 10, 15 new states and capture those markets. Again, that's going to cost money, sales and marketing. But I think it's going to come down to the unit economics and what's going to add to that balance sheet now that they had to take some debt to do this deal. So EBITDA is very important.
Yeah, and Dave, when I think about deals like this, I always think about how easy or hard it is to scale different types of cannabis companies nationally. And I think it's hard no matter what. But I think that if you're to go from easy to hard, maybe the hardest, in my opinion, is flower. We look at, for example, cookies. Like cookies started in California, growing a lot of fire. Long story, got into contract grows. Maybe the quality went down a little bit, but cookies was known in California for, great genetics and, growing great indoor flower. If you go to Maryland, if you go to New Jersey, you go to these other states, because we don't have interstate commerce, you're starting the process over there, right? New climate, new buildings, sometimes new genetics, new grower. And it can be hard to replicate the cookies quality in California with the cookies quality in Maryland. I'm just picking Maryland. I haven't had cookies in Maryland, but just using an example. Same thing with Jungle Boys, right? Jungle Boys, Southern California brand. Now in Florida, you talk about growing in 2 different places. Brady talks all the time about people bringing a California playbook to Florida and struggling for the first, 12 or 24 months trying to get those rooms dialed in. So I think having consistent flower across America when you're growing it in each market is a really hard thing to do. It's an extreme degree of difficulty. Edibles, and I'm curious your take, Dave, but it seems to me maybe to be the easiest one. And I say easiest, I don't say easy by any means, but you can maybe replicate those ingredients a bit easier, especially if you get into distillate, if you get into rather live resin and rosin as the oil you're using, then that can be a little bit trickier. But if you're purchasing distillate in different markets, it should be fairly similar, often at a very different cost, but a fairly similar product. And so I think with brands like Wild and some of these edibles that have scaled really well, maybe one reason you can do that is because you can get consistent products across states. Like if you drank Coca-Cola in California and then you drank it in Oregon and you had two different beverages, you'd probably would be like, man, I don't know if I want to get another Coke again. But because Coke and McDonald's taste, basically the same all across the country and all across the world, that scales really well. And it seems like in the edible space, maybe that's something that you can scale a bit easier than some of the flower stuff.
Yeah, I completely agree with that. I think there's just way more factors in flower, in your example, to have to control. Whereas edibles, there could, SOPs obviously play a very important part in why the execution has been there for a Kiva, a Wild, a Gruen, you name it in the edibles category, right? And a lot of these edibles companies are north of 40 million in revenue. Maybe some are a bit lower, but they've kind of figured out the playbook for how to bring it from state to state. I kind of, the example, the comparable I use is kind of like restaurant franchising, right? And that's exactly what Cookie did. They franchised out the brand for retail. They obviously franchised it out for flower way more than any other flower company. And when you franchise something out and have a franchisee essentially in every state that manages it, it's hard to get that same consistent quality. I think Chipotle actually owns their own stores. They don't really franchise it out. So in that scenario, you can actually control every single aspect of running that business. And it's very consistent, to your point. And that's in CPG important, right? Your Coke example, I used to work at Anheuser-Busch. I used to be a big craft beer guy before I worked there. I still am, but I have more appreciation for this consistent Bud Heavy, Bud Light in every state, every country. So I think it's CPG, which if you look at edibles, that's CPG essentially. So that's key to have that consistent experience. And that's why it's gonna be harder for some of these flower brands to expand, because you're just kind of handing off SOPs and control to someone else that you have to trust. So I think Jungle Boy is actually in Florida is with the Flowery, and I know they also have a relationship with 710 Labs. So if you look at that, it looks like they actually are a good caretaker of anyone in those categories coming into Florida, given just my assumption on who they're partnering with.
Mm-hmm. Mm-hmm.
But very hard to do multiple states like that.
Yeah, that's good points there. And one of the things we're trying to do more and more with the podcast is to try to give people, actionable information, things that they can take away to become, better investors, maybe bump their portfolio up a little bit, make better buying decisions day. And I'm curious, when you're looking at these types of M&A deals, we've been talking about some private companies today, but I think we can apply the same principles to the public space. And I suspect we'll see M&A heat up, a little bit more this year on the public companies, and possibly even more next year as some more financing opens, some more new states open. And if you're an investor listening to the show and you're looking at an M&A deal, and everyone's a little bit different, Dave, but I'm curious, are there any kind of guiding principles you would share, things to look for? Like, what are the biggest risks you see in deals? What are some red flags? And maybe then what are some of the positives where you look at that hated word synergies, but I think it applies here. What are the things you'd look for in terms of the synergies, the 1 + 1 = 3, and some tips you might give to investors so that when they see that a company that they're invested in is acquiring a set of dispensaries or acquires a brand or whatever the acquisition may be, give them some tips to look at it and say, hey, let me decide if I think this is a good deal and what are the risks associated here.
Yeah, I think, I'll answer your second question first. The answer to that's really just rationale, right? So if you're an MSO and you see MSO do an acquisition into a large, growing, newer state, makes sense, right? If you're going to Ohio, I think I'd be very supportive seeing something I'm invested in do that. And then secondarily, what do they pay for it? Was it a good acquisition? I pride myself as someone who's done M&A both in-house and as an investment banker on getting the best price relative to the market, right? So are they paying valuation that you view as attractive, and is the structure attractive? Oftentimes, and we deal with this, we also do a lot of beverage work at my firm. We've seen companies that have been around for decades fail because someone may have gotten too aggressive, taking on debt and just lost the company. We're talking about like multi-generational companies, right? So you want to make sure they're smart with how they structure the deals and taking on, we talk about EBITDA coverage ratios, but taking on debt that can be supported by that EBITDA that actually grows and doesn't get destroyed because they're making bad decisions after another. So those are the two things I would look for in any M&A transaction. Does it make sense? And did they get a good to great price?
Right. And another chunk of our user base, I'd say probably I don't know this for sure, but I suspect number one are cannabis investors. And I suspect number two might be cannabis operators. So often I'll be at a conference and I'll meet somebody that's, has a couple dispensaries. I'll pick Maryland again, just a couple dispensaries in Maryland, never met before. They listen to the show. They appreciate the tips and advice that they get. And so if you're talking to, operators out there, could be larger MSOs, could be literally somebody that just has, a store in one state. And I know, that, Morgan, I know you deal with this all the time, right? Like somebody has one store in New Jersey and they're trying to figure out what to do with it. And I know, Morgan, you've had a ton of these conversations where people just weren't realistic on valuations for the longest time. And it's been so hard to get deals done. In this post rescheduling world, Dai, if you are somebody that, let's say you're looking to be acquired, any tips you would give for them in terms of things to look for in the company that's acquiring you? What makes these deals work from an operator perspective?
Yeah, so I'll go with the larger advice. Build to actually be self-sustaining and get profits to control your own destiny. Don't build to sell, because oftentimes that's why some of the companies have run into trouble or have shut down or have lesser outcomes than you expect, right? Building to sell is hard, especially when you look at it in this environment. We don't have a ton of buyers. So when there are hundreds, if not thousands of people building companies to sell, and there's 5 to 10 real buyers, right? That supply demand balance doesn't really work. But if you are in a fortunate example to sell, like let's say Ohio as an example, if you're looking to sell, make sure you do good reverse due diligence. Make sure the buyer, the narrative, sort of the track record you trust, and you can, because you're likely signing on to some equity, right? So are you in it for the next 2 to 5 years? When can you sell all your shares if things get bad? And sometimes even like a lockup of 6 to 9 months may be too long in cannabis. So look at the lockup period, do the reverse due diligence, make sure you're comfortable signing up for that equity that you're exchanging.
Yeah. That's an obvious but great point, is that there are some cash deals being done, but there's a lot more stock deals, and there's a lot more stock plus some cash than flat out cash deals for obvious reasons people understand. And if you're on the other side of that, absolutely, you're trading your equity in your shop that you started in Maryland for equity potentially in a much larger company. And great point, Dai, you're going to be you might be hanging out of that for a little while, right? And so make sure you're comfortable with that time frame and what that exit liquidity looks like, and that. Maybe the last piece I'd say, Dai, on that one that strikes out to me, I think you said it earlier, but I'll just say it again, is the culture. The older I get, the more people that I work with, I just find that for a long-term fit, the culture is just so critical. Like, make sure you're in bed with people that you trust, like, respect, and you have a similar vision.
I think it's interesting too is the point about the supply-demand balance in M&A itself. And as to that point, Jesse, is like right now, I say anyone that's been operating in this space for a while, you have a pretty good sense of who these acquirers are. I mean, you might not have seen under the hood if they're private, so like getting that understanding of the cross due diligence. But should this pool change because of the larger strategics that have not been present, private equity that's not been present, like if they all of a sudden start dipping their toe in, these are going to be whole different groups of people that most in this industry have never met before. And so to that point, like, trying to assess that culture, we'll have to just cross that bridge when we get there. But it is really interesting right now is like the buyer set is very limited, but it could be expanding in ways we're just not aware of yet. We'll know in time, but I suspect that should be the case as other groups that have just been holding off on the sidelines. And like Dai, you're mentioning about with like Ignited's conference coming up, I would expect groups are going to start sending people in and starting to do work again and refamiliarizing themselves and learning about, who's doing what and how people are doing and how they've managed through this. But, those kind of groups, especially private equity, I mean, they're very much just financially motivated, right? They're not really as like some of these companies that are founder led, built from zero, have deep care for what they've built and want to see this, to a much bigger situation. But then there's also going to be the financial groups that will just come in because they see opportunity. And so, these dynamics are going to change likely. I mean, this is just what we think is happening with rescheduling going effective, bringing in more capital groups, how this whole space is going to change. And it'll be very interesting to see. And that's why I just wonder too about, I was asking before is like, how long will companies stay on the conservative side before they want to make sure that they're getting the assets they want to get before the dynamic does change? And I just wonder if that does happen. And, I made the correlation internally as this kind of like when the EV tax credit was rolling off, there was a flurry of people buying up EVs before that happened. And then there was a lull. And I think that's what's kind of in some people's minds is like, is there going to be a flurry of activity? And if there's not that bridge to the next capital coming in, is there going to be a lull? I mean, we'll just have to see in time. But, any kind of thoughts around that?
Yeah, I think, it goes back to just, if you look at the balance sheets of some of these acquirers, they're still very heavy on debt. A lot of them have a debt maturity wall that's happening in late 2026. So some of those refinancing conversations are happening. And, does it make sense to acquire something and take on more debt or use some of my cash to acquire something rather than service that debt, right? It's going back to that example I had of multi-generational business going, out of business because you make some bad decisions. These are what the MSOs have to deal with. Do we play offense or do we play defense? Or is it a mixture of both? So I don't think you're going to see a flurry of deal activities based on this announcement streak that we've had this week. A lot of these deals were months in the works, right? Starting out in the summer, it just also happened. Everyone wanted to announce it this week on the back of positive December news around rescheduling. But those conversations are happening, and they are with real people, and family offices are probably the first ones to come back. And those have been the conversations I'm sure we've all had the past month are probably with the family office people who feel they are more comfortable taking on risks. And especially for us, we deal with a lot of distributors, a lot of bev out people who are looking to what's next for their family beyond alcohol.
Right. Yeah, and it's interesting is one of the questions I was thinking about was how to classify some of these transactions happening. I know it's not really enough to fairly characterize it, but it's like, are some of these decisions coming from, to your point, like some of these MSOs, are they doing this to try to get themselves in a better financial position from a leverage perspective? Like, so is this more of like a survival tactic, or are some of these decisions truly from a long-term kind of strategic planning perspective? Just trying to get a read of how these decisions are being made. And to your point, because most of these were underway since last summer at a time when, confidence was low. So were people thinking of that as like, we've got to do this deal in order to keep ourselves in the game? Or is this really because we think this is going to help our business long-term?
Yeah, I think it's more about being opportunistic and what's going to be better longer term for their businesses. If you think about cannabis, and especially some of these categories, of CPG, right? Fast growing CPG oftentimes gets a 5 times revenue multiple. Cannabis and some of these deals being discussed, we're talking about more like 1 to 2 times revenue multiples. So you can kind of just see that jump in valuation potentially with rescheduling and descheduling, right? Maybe a 1 turn step up, a 2 to 3 turn step up. And so if you're opportunistic and you're confident in your core business, you want to go and play offense now and expand. So going back to that Wild example, okay, maybe our growth is somewhat tapped out because we have, Wild, we have Good Tide, we have other brands we're launching, but how do we go play offense and just become the market share leader? How do we go and get someone that, I think they had 75 SKUs that grew across 4 brands. How do we get someone that's great in R&D and innovation and can help us build that muscle in-house as well and continue to just dominate, right? I mean, if you look back to this confectionery or candy example, Hershey's was started early days. Mars came after. Hershey's was actually a supplier to Mars. There was actually a breakaway where the president of Hershey's and the son of Mars started M&M's, right? So if you study the history of candy, confectionery, and some of the companies we know today that are enduring, that's been around for 100 plus years, there's been this history of R&D of consolidation, and we're going to see that play out in this industry as well.
Any final questions from you, Jesse?
No, I think I'm good. This has been a great conversation. I think it was a good time to have you back on, Day. You have a real expertise here that I think is really helpful for me to learn from, and hopefully it's helpful for listeners as well. And I think that over the next year or so, hopefully you get a lot busier, and we start to see more deals deals done in the space. I think there's companies out there that can help each other. I just think that it feels like we've been stuck and the pipes have been clogged a little bit. But I think maybe we can unlock some value this year. So no, very much appreciate you coming back and sharing your insights today.
Yeah, thanks for having me, guys. Always enjoy the conversation and look forward to paying attention to what you guys are doing in the industry as well.
Yeah. Thank you, Day. It was great, and definitely looking forward to have you back on as this M&A cycle continues, and hear what you're working on and what you're able to discuss after they're all done and buttoned up. Because this is, I just think this can be, we're just getting going on this whole cycle, so which is good. I mean, our industry's been very fragmented for a very long time, and consolidation is a natural part of capital markets and capitalism in general. And so, it's no surprise that we see it coming in here. So thanks again. Just want to give a final shout out for our new sponsor. So Higher Exchanges is presented by Flowhub, the retail platform trusted by the best dispensaries in the country. If you haven't evaluated your tech stack in years, there's a good chance you're leaving money and efficiency on the table. Serious operators can see what's possible at flowhub.com.
Nice job, Morgan. You are a natural ad reader. Good to chat with you today. Day, like I said, great to chat with you. Thank you guys all for listening. Really appreciate it. And we're going to see you, I think it's 3 weeks from today, we're going to be back, and we've booked Jason and Ziad from TerraSend. So love TerraSend, love those guys, and so much to discuss. So see us back here in 3 weeks for that one. And looking forward to that. Talk to you guys soon. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research or a recommendation. All investing involves risk, including the loss of principal.